Yeah, and I think it's really important you understand that when you bring in capital, if a VC or angel investor writes a check to you, you are married. It is extremely hard to get out from under that.
And very often, even early stage companies lose control.
Yeah.
Right off the bat.
Yeah, yeah, which is unfortunate.
So it's both the cost, but it's also the control component of how to run the company. It can be challenging. I mean, if you're a founder and you've created this thing in your basement and you've been working on it for years and years and years, and you ultimately go out and raise capital, and your first round of capital you give up controlling interest or at least part of that, all of a sudden you're not in charge. Forget about what the cost is.
Yeah.
Or did you raise enough?
Yeah, which is also a problem. Give us the elevator pitch for lighter capital. I'd love to hear that.
We have 3 different types of loan vehicles, but the first one, and the one that I think we're kind of more famous for, is what we call an RBF loan. So we basically loan early stage companies capital so that they can grow their business, and the repayment is basically scheduled on the base of your monthly recurring revenue. So we basically take a piece of the action every single month, right? So that way, as the company continues to grow and or fluctuate as they continue to move up and to the right, that their payment streams are a piece of their overall revenue. We also recently launched a line of credit, which is for more working capital types, and we also have a term loan, which is basically calculated and set up not unlike the RBF loan. It's just that we set the payment structure in a more predictable versus variable fashion. So we effectively help early stage companies that have either tapped all the sort of angel or early stage money that they can get, and they're not quite ready for true equity capital from typical VC networks, and or that they just have a desire not to get diluted at all, because obviously we don't take any warrants, we don't take any equity in the company, and we allow founders to grow the business without actually giving up any equity or control. We also we don't take any personal guarantees, and we also don't collateralize these loans. So we really judge the performance and the credit worthiness, if you will, of our loans and our borrowers based on the fundamentals of their business.